All right. I think I'm the second last group until happy hour, so bear with us. Hang in there. And although the committee begged me to do my usual 19-minute presentation with 1-minute panel discussion, I will not do that today because we've got a lot to discuss. So thanks you guys for being here. This is a great panel that we have. This is a view from the street. And quickly, why don't you guys introduce yourselves, and then we'll jump right into it. Please go ahead and be spontaneous, be energetic, interrupt, be controversial. Anupam, why don't you start, and then go this way.
Hi, Anupam Dalal. I'm the Chief Investment Officer at Acuta Capital in San Francisco.
And Cameron Taylor, Managing Director at Bank of America on the banking side.
I'm Cariad Chester, partner at TCGX, $800 million fund investing in both public and private biotech companies.
Jason John, Managing Director at Citi on the biotech banking side.
Great. So just so the audience knows, we've got two investors, Anupam and Cariad, and then we've got two bankers, Jason and Cameron. So the first, I'll ask you questions individually as well, but the first question for all of you is the following. I just kind of want you to give me a rundown on where we are in Retina this year. The last time we were in a meeting like this, about a year ago, there were three things that we concluded. There were three talking points. There were three themes. The first one was there are strategics out there who are about to go off a patent cliff. Their pipeline appears to be anemic. They're sitting on piles and piles of cash, and yet there's a dearth of M&As. That was one. The second was there's a whole bunch of small companies that are very, very innovative, very energetic, have great science, but have a really hard time raising capital. And then the third was because of number one and number two, these companies, which are really development companies, have sort of maybe reluctantly been forced to commercialize. And that hasn't always been successful, and sometimes it's been downright disastrous. So that was the theme, I think I'm characterizing it accurately, this time last year. So Jason, let me start with you. Where are we this year? Fast forward. Has anything changed, and if so, what?
Yeah, thanks, Pravin. I think those observations are accurate. I would say there's actually been a nice pickup in M&A this year, where I think volumes to date has exceeded all of last year. So that's been very healthy from an M&A perspective. That's number one. I think there's been also an improvement in capital markets, where we are seeing an uptick in terms of positive stock price reactions, follow-on execution outcomes. I think the IPOs are still playing catch-up, but we are seeing some data points that are starting to be helpful, and for us to really gauge the health of the public markets. So I think, at least from a Citi perspective, we are expecting more activity this year. And let me just touch very quickly on M&A, because I think we all in this room sort of gather that that is a critical piece for our industry to function. So I think the strategics continue to evaluate a set of targets, and I think principally focused on that 2025 to 2030 year type time frame, where most strategics have patent cliffs. And really, if you look at the spectrum of public companies out there that have the ability to move the needle for some of these strategics, it is a relatively limited list. Having said that, again, that list exists, and I think we expect more activity, certainly for the rest of the year. And with that, with more M&A, I think we're expecting a continued uptick in public markets from an equities perspective as well.
Thank you. Cariad?
Yeah, no, I think I would echo that. I think everyone has those loss of exclusivity numbers just plastered on their walls in their offices, praying that pharma will swoop in and buy every distressed mid-cap that you're involved with. But it's true, right? I think it's no secret that investors are preferentially allocating towards companies where there is a near-term thesis around acquisition. There's clear value creation, there's a path to revenue contribution, and you can alleviate some of that loss of exclusivity burden. And so that is the sweet spot for a lot of investors in the current moment. And I think companies that aren't quite on the path towards near-term revenue are really forced to anchor their value creation story around true de-risking. And so I think we're in a more positive environment than we were but there still needs to be immense focus on that path to de-risking assets, a focus on products, and really driving towards how what's being developed is going to meaningfully contribute to revenue down the line.
Cameron?
I'd add on that in terms of it's de-risking and differentiation and being able to prove that. And I think within the ophthalmology field in particular, strategics have been more cautious. They've been able to be more cautious because many of them didn't have the capital to deploy over the last several years, and we've had folks that have gotten out of the field. We've had nice momentum and people coming back in, and we've seen new life of M&A, but there's still a way to go in terms of what we're going to see. But still, the strategics have been relatively conditioned to say, go prove me wrong. And to your point on launches, right, we actually haven't had many of those companies go out and say, okay, I'm going to do it, and I'm going to prove you wrong, and you really should have acquired me 3 years ago. They can look back and they say, well, that launch, for X, Y, or Z hasn't gone to plan. And I think that's where the differentiation comes in, is that as companies get that data, de-risk, and have that near-term path to say, okay, we are going to prove you wrong, that's where we're going to see, I think, strategic step back in.
Great, thank you. Anupam?
Yeah, I don't have a lot to add other than, we just don't typically invest with M&A in mind. I mean, there's a famous saying, which companies are bought, not sold. And if we meet with companies where the business plan is overtly get to an event and just sell, that's not super interesting to me. So, and my assumption is that a lot of the strategics are looking for the same thing that I'm looking for great drugs that are fun, transformative, disruptive, great intellectual property. Usually it's not that complicated.
But de-risked?
What is de-risked?
You tell me. Is that one of the reasons that we're seeing that dearth of M&As? At least we saw the dearth of M&As. And if we did see them, would you agree that it's really more the late stage companies that are being attractive? Or?
I mean, I think there's plenty of deals that have happened in Retina for non-de-risked assets. Was Hemera de-risked?
No. It's a good point. It was.
Hemera's a great company. Hemera's a great company, but I think strategics are. Risk is a gradient. It's not a binary. So,
For every Iveric, there's a gyroscope.
yeah.
Okay, I'm not going to touch that. Okay, so through the bankers, Jason, you, and Cameron. So we have seen some M&As. Sticking with M&As, are these one-offs, or is this the beginning of something that we're going to start seeing as kind of a domino effect? Cameron, why don't you go ahead first?
So I want to say that there's a domino effect, but if we think about biotech in general, there actually haven't been that many instances where M&A just leads to people saying, okay, I have to gobble up this, that, and the other. And we experienced that, 2014, 16 within sort of the spec pharma field. I think when we think about the Retina, which has become very biotech driven and getting to new data is going to drive it. And so it's hard to necessarily predict and to say that there's going to be M&A for the sake of land grabs, as opposed to when you hit that point, you're going to get that. So it's going to be hard to pin it out with a trend because it's going to rely on what happens in development.
Yeah, and you know what? I still want to push back on what Anupam said because I'm not in agreement at all. I mean, there's M&A as usual. There's M&A and there's M&A, right? I mean, there's always a profile of where M&A is occurring. I mean, it's the fact of it is that my impression was, and Jason tell me that I'm correct and he's wrong, but my impression was that people are waiting. Strategics are waiting for a long time and are willing to pay more for something that is more de-risked than bet on something that's earlier, that's less that carries more risk. Am I wrong in assuming that?
Yes.
I think, sorry.
All right, Jason, down the end. Go ahead.
Well, I'll jump in, considering I was deeply
go
involved
ahead.
with
That's what I want you to do.
Hemera.
Absolutely.
And
by the way, if he jumps in, you can push him too.
Yeah, no. So having been deeply involved with the Hemera process around with J&J, there were folks that said, okay, we're just not ready to take that risk, right? Other people may have wanted to pay, and I think I love the asset. I want it to be successful. And, I do think in that instance, right, J&J said we can do this and we can make something of this and use our organization to do it better. And so there are going to be times where people go early. Novartis, which unfortunately is, less active in our field, certainly did that within the AAV field for some time, right, to say we're going to go early and we're going to use our organization to build this thicket of assets. but it's still unique, right? And I think that those are the things that are harder to predict. And in this field, the larger transactions, those that have been most material have typically been late stage.
I think it's fair, but let's remember, first, well, Humira is a special case because it's private. But on the public side, Cariad and I are, if companies are de-risking themselves and they're public, their price is going up. So de-risking and the price that you pay are not unrelated for the strategic.
No, absolutely not. But then again, maybe the reason is, and chime in on this, maybe the reason is that before, go back a little bit, we've seen some spectacular failures, right? And maybe what happens at that time is these strategics take a pause and say, wait a minute, I'm not going to be part of that anymore. And what I'd rather do is to wait until I know it's, as I say, de-risk. And how do you define de-risk? That's a fair question, right? I would define it as a company that's either commercializing or about to commercialize. That's how I would define de-risk. It seems to me that the bets are going more there than they are in the very early stages that I would see. And that matters because for a lot of small companies here, they have to plan that out and say, look, how much capital do I need and what's my life cycle going to be? It's a profound question. Jason, go ahead.
Yeah, maybe I'll just jump in here. I think there is a reason why I think 2/3 of substantial biotech M&A is typically in that sweet spot of post-phase 3 top-line data and prior to launch. I think that is, at least from when we have advised on situations, that is what I think the buyers regard as relatively de-risked, where you have an extremely high 80 to 90% plus POS to get to approval, and you can control the launch. The number of times that we see deals break down where there is just a fundamental, for example, buyers are not big fans of fixing broken launches. I think once a product launches and has challenges, it becomes very hard to change that perception and the trajectory, which is the reason why prior to launch, I think that absolutely is the sweet spot. And I think, again, it just goes back to what some of the priorities are for the buyer, which is, again, the ability to replenish the near-term revenue. I think it always comes back down to that. There has been a recent exception recently. It's not in ophthalmology. It is in immunology, where we have seen a slew of large M&A in that sort of post-phase 2, pre-phase 3 type stage, which is a bit of a departure from what I just mentioned. You look at companies like Prometheus, DICE, you even look at IgAN and kidney for Chinook. That's been a bit of a departure, which again, from our perspective, highlights the dearth of high-quality assets, pointing to, I think Cameron and Anupam and Cariad all mentioned differentiation, right? There is just a lack of differentiated assets that can be truly disease-modifying, that have the ability to be first-in-class or best-in-class, which ultimately is what the strategics are looking for, and they will have that certainty post-top-line, at least top-line phase 3. Which is what I would characterize as true de-risking.
So, but that also is a dilemma for companies because companies are built to develop a product, right? And then now, because of what we said, if we all agree that, look, there's a propensity to wait until de-risking, if we define de-risking as about to commercialize or just having commercialized, to switch from a company that's a development company to a commercial company has not been successful. Am I wrong in saying that for most people? I mean, it's a really difficult switch, but it's almost like the companies are reluctantly forced to do that. Am I wrong in saying that?
Maybe I'll just jump in. I think there is sometimes I think we hear when you see a biotech commercialize themselves, they sort of tried and failed to sell themselves, to your point. I think the one exception is something like a rare disease where, say you take a sub-$500 million peak sales product that has a very well-defined patient population, you know exactly who the prescribers are, very concentrated sales and marketing. I think those launches have actually done well. However, outside of that, I think we all know that commercial launches have been very tough. So again, just speaks to, again, I think a lot of companies, struggle with the pivot. I think we forget that a lot of the biotech founders, the CEOs, are fundamentally, clinical and science backgrounds and oriented. And to make that pivot into a commercial company, again, when the complexity kicks in terms of the quarterly volatility based on whisper, based on guidance, do you focus on top line or eventually when do you focus on bottom line in terms of EBITDA or EPS? Because that point does come in the company's evolution. That is admittedly something that I think most biotechs have struggled with.
You guys, go ahead.
How do you square Apellis with that?
Sorry, in terms of?
How do you square Apellis with that? Did Apellis, what do you think of the launch so far? Well, I'm not, obviously not the event, but.
I think where it plays in, first to market, right, going into a new category that hasn't had an approved therapy, so that falls into actually, I think, that same sort of, whether or not that's rare disease, but completely unaddressed, and you're going to be first, and so there you can actually go with, right, the FDA's guidance on getting a therapy approved, but if you're going into a crowded market, then it's the question of, right, how are you going to differentiate again? If you're going to be the fourth or fifth asset in that category, then it's
But my point is that they made that switch so far pretty well,
very.
right? I'm not, the recent events, let's not get into that, but that was pretty impressive. I mean, the launch so far has been robust.
Yeah, I would say, I'd agree with you. Look, I think if you take the recent events away, I think the launch so far is very successful, right? I mean, I would say very successful. If you look at the numbers the first month, they were great. They were much higher than expected. Now, is that an exception or not? I'm not sure. But I'm not sure Apellis is a small company either, and they're a large company, and they've prepared for that very well. Not many small companies get that luxury, right? So, I'm asking you this. I wonder if that's an exception as opposed to the rule.
I think maybe one of the lessons from Apellis, though, is that when you do prioritize massive unmet need and you're coming with a first-in-class product, that you can be rewarded by investors, by the market broadly. And I think that the debate around the terminal value of the GA opportunity with the TPP Apellis is advanced, is always going to exist, but it was an incredible launch out of the gates. I think it's a reminder of how much value you can capture when you're doing something innovative.
Yep, and it's also a reminder of what opportunities exist, right? And it's a reminder that there's this enormous number of patients out there waiting to get treated. Let me switch a little bit now to the strategics themselves. It seems to me, and this is for all of you, that the profile that we have of the strategics in our field has changed a little bit. We got the stalwarts still. We got the Roches and maybe the AbbVies. We've got some that used to be stalwarts that are no longer around, like Novartis, for instance. We've got some, and this may be unfair, that seem to perpetually be on the sidelines. The J&Js maybe, and the Mercks and the Pfizers, and then we may have some new coming in, like Astellas. Do you think the strategic profile is changing, or is that just a coincidence?
Happy to start.
Go ahead. Yeah.
Right, Retina is a $15 billion and growing market. I think the demographics are destiny in terms of the opportunity set here. So I think everyone is looking for a way to break in. Yes, we have the stalwarts, but there's a lot of companies that have dipped their toes in, right? AbbVie partnering with Regenxbio, and you have kind of down the line Merck exploring plasma kallikrein, Boehringer Ingelheim exploring iPSCs. And so I think there's definitely appetite, and it just becomes a question of what is that entry point? If Kodiak had gone on to be competitive, I think there would have been a buyer there. And so I think we have the stalwarts that have an incredible pipeline of assets they're advancing, but I still think there's incredible opportunity for anyone that has a transformational product. And that's what we see with the Stellus buying into the Iveric asset.
Yeah, and I would think that also you have two big eye care companies in Alcon and B&L that are maybe underrepresented within the RX field of retina, that hopefully do more and get into this field. But also if we think about other pharmas that are not yet in the eye, and we look at the dearth of opportunities to go and build further in immunology or to go into oncology, I think if you can provide good clinical data or perhaps early launch to say, all right, I can come into this field, I can go after the 2,000 retina specialists and win and find a way to build a franchise, I think there will be more people that will be able to do so, and that will still take time, but it definitely will be something that people continue to monitor.
Yeah, I think that was well captured. The only thing that I would add is that relative to, say, oncology and immunology, where you have every single strategic playing, ophthalmology does tend to attract, to Pravin, your point, a smaller, more defined group of buyers. And I think we see from the Amgen Horizon deal, it takes almost a cornerstone asset to really build around for a new strategic who's not currently in ophtho to make that entry. That's a really important piece. And again, we see, I think, Cariad, you mentioned this, some of these players who are less traditional ophtho do see it sort of early clinical, preclinical type collaboration deals. That's all great, but really what it takes is that late-stage asset that will produce real, billion-plus peak sales to build around that will really propel some other buyers to come into the field.
So in the last few minutes that we have, we've got about 7, 8 minutes, what I want to do is to get specific into the targets that we have. And I just want you to kind of throw out what you're thinking of these targets. Good investments, bad investments, not really all that interested. What about wet AMD? There's a lot of stuff happening in wet AMD, but it seems like, Eylea always wins, right? It's like the golden cockroach that doesn't die. It just gets bigger and bigger and bigger and bigger. As they go from 2 milligrams to 4 milligrams to 10 milligrams to 15 milligrams, it just always wins and it's always there. And you've got biosimilars and you've got all kinds of, different other stuff with delivery products. What are your thoughts on investing in wet AMD?
I think there's still an enormous amount of discontinuation, undertreatment, and suboptimal outcomes with anti-VEGF monotherapy. And so, we got the quarterly print from Vabysmo today, 614 million, 30% quarter on quarter. It's an incredible launch by any metric.
Yep.
And I think it's a testament to how much efficacy is still on the table. You can leverage novel mechanisms and really add to what we're seeing from anti-VEGF. I think we're going to see more of that. That's a hard path to develop against, but it's incredibly valuable when you get there.
Anybody else? Differing opinion?
My view is, the bar, if you're in the VEGF space, the bar is extremely high, and I think it's valuable to kind of think fairly quantitatively about that bar, because to me that defines a lot of pathways. So what level of risk are you prepared to take, and what number of subjects exposed extinguishes that risk? When you go through that analysis and you think about what level of inflammation, for example, we're willing to accept, to me it's a very stringent opportunity set. So I agree with Cariad. It's an incredibly valuable market, and we have access to kind of well understood pharmacology. But you got to be very careful. And so for me personally, this is why we've been very interested in well-established delivery platforms for TKIs.
Yep.
Because I think it solves the unmet need right now that we have, which is durability, but in a way that is well understood. And I can choose the number of risks that I want to take, and it's not massive.
Yeah, my feeling about the wet AMD market is that we've got a biomarker problem, in that we've got too good a biomarker. And it's just one of the historic serendipities of science that OCT happened to come at exactly the same time as the anti-VEGF. It's just the perfect biomarker. And we've been so spoilt by that biomarker that measures permeability, which is VEGF, that everything else sort of goes out the window, and we have no idea how to measure it. I mean, you look at faricimab. I don't know if Ang-2 is doing anything or not. I have no idea. It probably is, but how do you measure it? I mean, how do you measure neuroprotection? How do you measure all these other things that we should be measuring? We just have a biomarker that overwhelms everything else, and we have nothing else. And I think that's a problem in developing other mechanisms. What are your thoughts about geographic atrophy? And again, just to address the elephant in the room here, what's the derivative of everything that's happened? What's the implications, if you take Apellis out of it, of all the other companies in geographic atrophy? Are there going to be long-term implications of this for them?
I think two separate questions in my mind. First, kind of what is flavor du jour in geographic atrophy? And no question, it's complement, right? I think that goes back to human genetics, even as far back as chroma and spectri from Roche, complement factor D, and now looking at how many different pieces are on the chessboard, there's multiple bets in complement. And I think it's going to be really exciting to watch which of those different targets are going to generate additional clinical value beyond what Iveric has with C5, Apellis has with C3. And so I think that complement programs have proven that there is some efficacy that you can squeeze out of targeting different nodes in that pathway, but we haven't quite identified which pathways should be inhibited for maximum efficacy. And I think that's the experiment playing out in the clinic right now, and there's probably targets that aren't even in play that are still going to add to that efficacy equation. And I think the second piece of the question is, what is the Apellis safety concern going to do for the field broadly? And I think it's going to be a question of, to Anupam's point, how many patients do you need to treat before you can de-risk safety concerns? I think that's probably going to be an evolving goalpost as we see the next few quarters and monitor just how much vascular retinitis we're going to see.
and I think the inspiration of how well the launch had gone, right, in terms of, and hopefully continues to do for everybody in this room and for patients as well, right, is that that's going to inspire other people to go after this, and this is an area that will continue to evolve. And I think that we're still very much in the first innings. And when we really also look and say, going back to wet AMD, Eylea and Lucentis has been really hard, right, for somebody to go and to surpass. And the question will be is do other mechanisms come out? Do other ways at hitting within the complement pathway seem to work? And do they, serve as that king of the hill that just continues to push other people down? Or will there be, up-and-comers in the next 3-4 years that show clinical data that's differentiating? And, maybe different endpoints, right, that people go after to say, here's how I want to promote my product or to push my product. And I think, with what we've seen and just generally in the retina, whether or not that's extended release or others, right, injecting things into the eye is not trivial. But, I think it will still be something where, good early preclinical work and into the clinic and monitoring, people will still take risk and continue to press forward.
Any other thoughts?
I think that, there's good news and bad news, right? The good news is this year we learned that we can get a GA drug approved. We learned that a company can be acquired, even led by you. And we learned that, and we learned that I think one of the epiphanies for me that I never expected was the level of patient demand for this therapy. I think for all the angst that the investor community had about will patients show up and who's going to use it, I think consistently we hear about surprise by treating physicians as to the level of pull from patients who really care, never expected to lose their vision at that point in their life and want to do something about it. These are all great things for the space. I think the bad news is that we all appreciated up to this moment that one of the challenges with funding earlier stage GA programs was that you really have no idea until you have an idea. There's just, you mentioned the OCT, we don't have an analog for that, really, in a PD marker that we can use effectively. So you have to run essentially a 240 to 250 patient randomized study, which means you now need a sham. You have to go out to 48 weeks just because of the kinetics of the underlying disease. And that was just to answer the efficacy question. What I think recent events have told us is now we have to start thinking about, and Cariad mentioned it too, how are we going to get at safety? That's something we'll be wrestling with for years.
Yep. Jason, any thoughts there?
No, I think, really after wet AMD, I think there just hasn't really been these sort of large-scale, retina indications that have had much success. So I think from my perspective, it's just really exciting to see the approval and then, again, the very successful launch. And I think that enthusiasm, the launch, all the progress has been very helpful for other retina companies in the space, undoubtedly. And I think, judging by some of the companies coming through to us, we are seeing just a real explosion of companies actually looking at different targets, how you can potentially be synergistic with complement, some other more novel targets perhaps that are less validated. But I think these are all signs that we see when there is actually real interest from investors as well as strategics. So I think I would actually say that as a pretty healthy sign for all of us here in this room.
Yeah, my thoughts on GA in general is that it's obviously Apellis has shown us in their launch that the market is big enough. They as you said, I think before this incident, their launch was very successful. So clearly there is a market there. The challenge is going to be there is no animal model, and all of these complement pathways that we're talking about are species specific. So there really is no preclinical. It's a huge investment to go right in the clinic and bet on something without any backing really whatsoever, right? And you can't compete against sham anymore. You've got to compete against a drug, whatever drug is in the market. So, but the field is there. So it's an incredible challenge there. But I look forward to all kinds of new innovation. I honestly do believe that it's a domino effect. I think we're going to start seeing more and more strategics in this field. I think it's just the beginning. I think we can see new strategics in this field. I think culling some of them is not a bad thing at all. But I think we'll be sitting here sometime next year looking back and saying, man, we've got an entirely new profile of people that are looking into our field, and it's just going to energize this field even more. The opportunity is certainly there. So we're over time. Thank you all, Jason, Cariad. Thank you, Cameron. Thank you, Anupam. And it's been a great panel. It's great to be with friends, and thank you for being here. Thanks for your time.